Today on the Purpose-Based Retirement, how can you be sure that your financial advisor is putting your best interests first? If you're divorced, what kind of Social Security benefits can you qualify for? And we've all enjoyed the bull market, but what's next?
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Thanks for joining us here on the Purpose-Based Retirement. I'm Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're beginning the program today diving into a subject that I think is really in your best interest, and that is understanding whether or not the guy you're sitting across from is acting in your best interest. People are confused about that. They assume that somebody with a lot of initials after their name on their business card is looking out for me, but boy, you can't make that decision.
No,
you can't make that judgment.
You can't, but we should be able to. I think in this industry, we absolutely should be able to. It seems weird today. You Google fiduciary, and you're going to have tons of results. Google fiduciary and click on the news tab in Google, and you're going to have dozens of results. And it didn't used to be that way. It's like fiduciary is all of a sudden this new concept, and it's not a new concept. Being a fiduciary has been around for centuries. I mean, the last couple hundred years, we've known what a fiduciary is, and all of a sudden now people are coming in going, what's a fiduciary? What's a fiduciary do? And a fiduciary in common law is a relationship of trust and confidence. And you have these types of relationships with other trusted advisors that you're dealing with on a daily basis, be it your attorney, be it your CPA. They typically have some type of code of ethics that they have to follow, putting their clients' interests first. And the same thing's true with your doctors, right? They've got a Hippocratic oath. And it's not true in the financial industry. There is not this uniform responsibility to act in your client's best interest.
So on the screen is the dictionary definition of fiduciary, and as Casey just said, it does involve trust in the relationship between people. So when I go in and sit down across from an investment advisor, I just assume that they're operating at a rule of fiduciary, right? They're looking out for me, but they might be operating under something called the suitability standard.
Well, if it's an investment advisor, then you should be sitting down with someone that's operating under the Investment Advisory Act of 1940. So someone that's actually a fiduciary, right? If they're an investment advisor or they're an investment advisor representative, they work for a registered investment advisory firm, they're an RIA or an IAR, this is the only way you can have a fiduciary responsibility for your clients, a legal responsibility to put their needs ahead of your own. So you say this really isn't a new concept, even in our industry. You've had the ability to register as a fiduciary since 1940. But what you alluded to there is exactly the problem in the industry, which is what the heck am I looking at when I see on these business cards? I've got financial advisor, I've got investment advisor, I've got wealth consultant, I've got all these different names for financial advisor. How do I know who is actually in an advisory capacity and who's just a salesperson? And about 80% of advisors are still brokers. They're still acting in that sales capacity, selling products, selling investments, rather than acting in an advisory capacity where they have a fiduciary duty for their clients.
So let's take a look at the key concepts in being a fiduciary, and that is you have to put the client's interests above my own. So that means there's no room to conceal conflict of interest, and all fees and commissions have to be disclosed. Now, that just seems like that's basic in every day. Isn't that what everybody is going to advise me, following those rules?
It should, however, that's not the case. There is specific licensing that you have to hold in order to have that requirement to follow, in order to be required to act in the best interest of your client, full disclosure, disclosing any conflict of interest, disclosing compensation. Those happen if you're a Series 65 licensed individual, as an investment advisor representative. If you're a Series 7 7 individual. That means you're a broker, right? You're a broker working for a brokerage firm, an insurance agency, or maybe working for one of the large wire houses out there, the biggest brokerage houses in the world, the biggest investment advisory firms in the world are really brokerage houses that employ salespeople, and that's their big argument today against the Department of Labor.
So they're following what's called the suitability standard, right? I mentioned that earlier, and I understand that to mean, and you check me if I've got this wrong, but I understand that to mean that I have to offer you a product that is suitable for your needs, but maybe not necessarily the best product for your circumstance.
Sure, it's not like they can sell, mom that's 75 years old, underwater basket weaving stock from Brazil, right? It has to be something that is fitting for what they came in to accomplish, be it growth. So their goal was long-term growth. Well, I can still, if I'm falling under a suitability standard, a Series 7 advisor, then I can still sell you the American Funds Growth Fund. Whereas, I could have sold the Vanguard Growth Fund. It would have been lower cost, better historical performance. However, it's still suitable. Now, working with an investment advisor representative or someone with a fiduciary responsibility, they have to go with that Vanguard fund, right? They have to prove why they're using one fund over another. And it would be very difficult for someone to make the argument that I went with the fund that had poorer performance and higher fees and expenses and say that that was in the best interest of the client. However, you could still make the argument that it was okay, and that's what suitability really means.
So how do I know whether or not the person I'm sitting across the table from is actually working to my best interest?
Yeah, well, I think it really starts by one, looking at their licensing. Are they Series 65 or are they Series 7 licensed? And that's a good foundation.
Do I just ask?
Yeah. Well, you could look them up on BrokerCheck, for instance. So you could go to BrokerCheck. BrokerCheck, I believe it's brokercheck.org, where you could type in the name of the firm or type in the name of your advisor, and then it's going to populate the background of that individual, which you should be doing before you ever hire a financial advisor anyways, in order to see if they've ever been arrested for that matter or have anything bad in their record. It'll be listed right there if they've ever been sued for that matter, right there on BrokerCheck. And if they are Series 65 licensed, then it's going to have an extra link that's going to take you to a separate website because they fall under a different regulatory body.
So when I see all those letters behind their name on their business card, which ones tell me definitely that I'm dealing with a fiduciary?
Well, and that's the problem today, is there really isn't anything such as that. And this is exactly why we've had this fight here. And this is kind of the same argument that you're seeing brokerage houses have against the Department of Labor. The Department of Labor is trying to set it up so that everybody has a uniform fiduciary duty if they're going to act in an advisory capacity for the people that they're working with. And this has really come out of really the evolution of what's happened in the money management industry over the last, say, 50 years. You go back to the 70s and 80s and you find that, okay, now we had discount brokerage houses come out. So we had discount brokerages, now commissions started to get lower on mutual funds and mutual fund industry. And then we saw back in the 90s and 2000s, we hit that part of the time frame, and all of a sudden we had the introduction of the internet, online brokerage houses. We saw the proliferation of ETFs, and now we're seeing robo-advisors out there that are helping lower our costs even more, managing our funds for pennies, and also doing some tax management at the same time. The brokerage industry in a stretch to provide value and put themselves in a position to be more competitive against these lower cost options, they had to put themselves out there as financial advisors, wealth consultants, financial consultants, when in reality they weren't actually acting in that capacity. They were acting as salespeople. And ironically enough, this is the argument that the brokerage industry and the annuity industry and the securities industry lobbied, and actually looks like they may have won this argument in the Fifth Circuit Court of Appeals. This may end up going to the Supreme Court, but it may be dead altogether. They made the argument that their brokerage individuals, their salespeople, are not actually acting in an advisory capacity. They're just selling products. However, on their business card, it says financial advisor. And at the very bottom of their card, it says registered representative broker, right? Broker, stockbroker has become just a footnote on their business cards. And we can't even tell if we're working with a real financial advisor, someone that's actually going to offer us advice or not. And I think that's hopefully where this this heads. I think there's still room for salespeople in the industry today. We've got people that call into our office, they want a long-term care policy, they want a guaranteed income, they want an annuity, they want a life insurance policy, they want an investment vehicle, they want some product to just be sold to them, and they want to move on, and they're going to pick it out themselves. There's still room for that in the industry, I believe. However, we need to have a black and white where we know the person that's sitting across from us is a salesperson or not. If we can change the regulation around just the names that we're using for financial advisors and say, I am a broker, or I am a financial advisor, I am an advisor, maybe we only have 2 titles, that would make this so much simpler for the consumer and for the client that we're working with. But even bigger than that is, who cares if once we figure out this fiduciary thing, because now we have to figure out if the person that actually offered us that fiduciary advice had the competence level in order to act in our best interest in the first place, because we're still not discussing competency requirements, training requirements, education requirements. There are no education and competency requirements in order to be a financial advisor or a broker for that matter and act in somebody's best interest. That's what has to change. We need more barriers of entry into this industry so that we can make sure the people offering us advice are competent enough to give us that advice in the first place.
Well, let me assure you that if you're one of the next 10 people to call the number on your screen and you're talking to somebody at Howard Bailey, you're talking to someone who has your best interest at heart. And I do hope that you'll pick up the phone and make that call and ask for that complimentary review of your retirement plan to take a look at fees and expenses you might be paying, where you can save some money. What's the tax structure? Are you set up for all the things that you need to think about as you plan for your retirement? Or are you just stacking a bunch of mutual funds together and hoping that it's going to work out for you? Be one of the next 10 people to jump on the phone and ask for an appointment with Casey or a member of the Howard Bailey team, and you'll have that review to let you know exactly whether you're headed for a purpose-based retirement. All right, when we come back, we're taking viewer questions, so you stay tuned.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
Welcome back to the show. This is the segment where we answer your questions, and we're going to begin today going to Warsaw and Jane.
Hi, Casey. Thank you for taking my call. I have an old long-term care policy, and I've owned for over 20 years. How do I know if it's still up to par?
Well, Jane, it starts by figuring out what you have, and I think there are a few key pieces of information that you're going to want to understand about your current policy as you start comparing it to newer policies. So you might want to do some black and white comparisons of traditional long-term care insurance, assuming that's what you have. You might want to compare those things. That might be the premium, the benefit pool, might be the monthly benefit, and really importantly, the qualifications. Some of those old policies never ended up paying out ultimately for long-term care benefits because they had very difficult to qualify for requirements. And the long-term care industry has changed tremendously over the years, and a lot of those requirements have now been required due to regulations to be in there to make those benefits easier to qualify for. However, that has also resulted in long-term care premiums being higher today than they might have been in years past. So the first thing you want to do is do a little black and white comparison, compare your old long-term care policy to a new traditional long-term care policy, and then start looking into alternatives. Now, you're going to have to work with an independent advisor in order to do this because the big old brokerage industry hasn't really caught on to the asset-based options that are out there today with great companies and great insurers providing much more flexible benefits, improved benefits, and longer-term coverage, and even death benefits that can be passed on tax-free to your heirs. They just haven't caught on to that yet. So you really need to make sure you're working with an independent advisor as you start looking at different options, and look at more than one. I think it's very important that you look at traditional long-term care insurance, look at some asset-based options, life insurance options, annuity options, so that you know why you're making the decision that you're making. Don't just go in and buy the first thing that you're pitched. You really want to sit down and compare all those different options and make sure that it's the right thing to do to move, because some of those old policies, they were pretty darn solid. I had a gentleman the other day that I worked with that was retiring with a plan that he was paying about $600 a year for, and it had about $300,000 in inflation-adjusted benefits. It would have cost him thousands of dollars to get that same plan in the environment we're in today. These things cost a lot more today if we're going with traditional long-term care insurance. So just take some time, make sure you understand what you have before you make the move, and understand ultimately what you're getting.
Hey, thanks for your call. Let's move up to Elkhart, Indiana, and Kelly.
Hi. If I get a divorce, do I retain any of my ex-husband's Social Security benefits?
Well, Kelly, the answer is not so simple. There are some requirements in order for you to qualify for an ex-spouse's Social Security benefits. One, you have to be married for at least 10 years. You have to be old enough to qualify for those benefits. You'd have to be at least age 62 in order to get those benefits, and you can't be remarried, so you can't get married again in order to make sure you can continue to draw on an ex-spouse's benefits. And the amount of benefit you're going to be able to get is 50% of the primary insurance amount, or the benefit at full retirement age. If you're younger than that, then you might get less than 50% of that benefit. And there's also some things to think about that I think kind of require some consultation. Something happened with my mom, for instance. Typically today, what you have to have is you can't file for an ex-spouse's benefits if they are lower than your own benefits. However, my mom was in a position where she still was able to fall under those old rules. She ended up getting divorced, and she was able to file for spouse's benefits that were just slightly lower than her own, and that's called the deemed filing rule. She was able to delay her own Social Security until age 70, until which she'll get a much larger benefit at age 70 she's getting today. She essentially picks up some free cash. Most of those loopholes were closed, but not for everyone. There's another thing to keep in mind, and that is if you file for a benefit and your spouse ends up passing away, your ex-spouse passes away, then you're going to get bumped up to their full retirement benefit. So it's going to go from 50% all the way up to 100%. So, and if you've had multiple marriages, there is the opportunity or potential that you could file for multiple spousal benefits on different ex-spouses. So there's a lot to think about when it comes to Social Security claiming. It's not as easy as just going in and claiming. It really takes some consultation to make sure you're making the best decision for your income plan moving forward.
If you'd like to be on the program with a question, info@howardbailey.com. And that's what Barry did. So let's get to his question.
Hello. Yes, I've been a follower of your radio and TV show for quite some time now. My question is, how do I know how much money I need to retire?
Boy, Barry, that is the question of the day, and the most often question that we get asked in the Howard Bailey office: do I have enough to retire? How much money do I need to retire? Everyone wants to know the answer to the magic question, and quite often what can get you in trouble is using that 401k calculator when you log into your 401k and it tells you how much you need to have in your 401k before you retire. There's a lot of assumptions that are being made there, and a lot of risks that aren't being defended against or being even accounted for that matter. And so when we really start figuring out how much we need to retire, it starts with building a budget. I know everybody hates the B word. Nobody wants to build a budget as they step into retirement, but that's where we have to start. I know maybe you never lived on a budget for your entire working years, but I'm telling you, now you're on a fixed income, you're going to have to start to budget for the rest of your life. So we might as well start early. So let's start putting together a budget, and then let's analyze your different income sources and identify your income gap. Once we've figured out how much income we're going to need out of that retirement portfolio each and every year, then we can start analyzing our risks. So we take a look at our emergencies. Do we have an emergency fund? Then do we fund our income strategy? How much do we need to satisfy that income plan? Then we can carve out a portion to set aside for inflation. We can carve out a portion for long-term care needs and major health care expenses in the future. And that's how we ultimately start to build a plan that tells us exactly how much we need in order to retire. But it has to start with the budget. budget and lead into the risks, and ultimately let's deliver a written plan that you can understand and you can pull that thing out at any given time and look at it and know that you have all your major risks covered.
All right, well, good questions all, and if you'd like to join us with a question, info@howardbailey.com is the key. We have an opportunity I hope you'll take advantage of, and that is to be one of the next 10 people to jump on the phone and request a complimentary review of your entire retirement plan. It's a chance to learn more about what's going on in that portfolio, taxes and fees you might be paying that you might be able to not pay. You'll also take a look at how is your risk. Are you taking on more risk than maybe you should at this point in your investment career? Lots of important things will be on the table as you sit down with a member of the Howard Bailey team to learn more about your retirement plan and put yourself on path toward a purpose-based retirement. So I hope you're one of the next 10 callers to pick up the phone and call right now. Well, let's move ahead to our question of the day, and it has to do with exactly the stock market. What is the longest bull market in history? How long did it last? We'll have the answer when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
So as we left you in the break there, we asked our question of the day, and it was, what is the longest bull market in history? How many months did that last, Casey?
The longest bull market in history was a jaw-dropping 117 months long. Option B there was the second longest bull market throughout history at 108 months. If we look at the top 7 bull markets throughout history, we can see that we are now again in the second longest bull market throughout history. And just to provide you some context, the difference between a bull and a bear market. A bull market is an extended period of time of which we see increasing equity prices. A bear market is an extended period of time of declining or flat equity prices. And what we can see is after each one of these major bull markets throughout history, we have had a major bear market and a major pullback that has taken a while for us to recover and get back to even. That period of time is a subsequent bear market. That subsequent bear market decline from peak to trough. In the longest bull market throughout history, from 1990 through 2000, we had the tech bubble burst. We had 9/11 happen, and the market lost almost half of its value, 49% of its value. If you had $1 million, then after that, you had about $500,000 after just a short period of time, just a couple of short years. You had a total gain of 470%. On average, we have seen an average subsequent bear decline after one of these major market pullbacks of 51% from peak to trough, going from the bull market shifting into that bear market. What is going to be next? We are now not only in the second longest bull market, but also at a 327% gain, or roughly over 300%. We are now finding ourselves in a bull market that is the second biggest bull market on a percentage basis as well. And why is that so important? Now, if you're 20 or 30 years old, your dollar cost averaging into your 401k, it's probably not a major concern because you have a long time to undergo these major pullbacks and these different bear markets and bull markets that we're going to be going through on your way to retirement. Now, if you're at or near retirement, in retirement, they become a very major concern because of something called sequence of investment returns risk. Now you have an immediate need for a portion of those funds in order to fulfill your expenses that you have every single month. And so we have to watch out for something called sequence of investment returns risk. And I'm going to share this with you with a little exercise and a little example. What if you could make 8% per year? Would you want to make 8% a year? And I always get full participation at my events when I ask people if they want to make 8% per year, just like if I ask people if they believe that taxes will be going down in the future. I always get full participation because everybody keeps their hands in their pockets. Let's say that we can make 8% a year and you pulled 5% every year out of your portfolio, you shouldn't run out of money. However, the market looks a little bit more like this. There are peaks, there are valleys, and if you're retiring at the tail end of a major bull market, you may experience what this fella experienced as he walked along this 8-foot average depth creek, but then the creek dropped 40 feet. If we go back to 1989, we can stress test this. If we go back to 1989 through 2008, we would have averaged 8.43% a year right there at the bottom of your screen. And you can see through that first major bull market, the one that made about 500%, we can see some big returns up 31%, 37%, 22, 33, 28%, some huge returns during that bull market and the subsequent bear market decline through 9/11, through the tech bubble popping, and then recovering around 2007, only to see the financial crisis rip it out of our hands. Even so, we still averaged 8.5%. Now, if we flip those returns, this is where we're going to start stress testing. If we make 8% a year and pull 5% every year, will we run out of money? And what we can see is averaging 8.4% a year, whether we have those returns forward or backward. If we have $1 million, we pull out 5% every year. That's $50,000 a year. The blue line is starting in 1989. By the time we got to 2008, we would have ended up with $3.1 million. We would have started with $1 million, spent $1 million, and still had $3.1 million, having the bear markets on the tail end of retirement. Had we had those returns flipped, still averaging 8.5% per year, when we had those losses on the front end of retirement, we would have been violating the #1 rule of investments. We would have been selling when the market was low. We're supposed to buy low and sell high. Subsequently, we would have found that 20 years into retirement, we had some great returns towards the back end of our retirement years. As we entered that bull market, we still would have ended up with $235,000, flipping those same returns and having the bad years on the front end. Here's my question for you. You have to ask yourself if you have an income plan or if you just have a portfolio of investments and you're buying and hoping. What will you do the next time we get the worst? What will happen is we have to figure out where we're going to go. Where are we going to go for our income needs if our portfolio is down in value? Do you have a backup plan? Do you have an emergency fund? What if you have a major healthcare expenses during a major bear market? There's never been a more important time for us to have this discussion with our financial advisor, with our financial planner, because we are undoubtedly so nearing the tail end of a bull market, and we see that the average subsequent bear market decline is 51% from these peaks. It may not happen tomorrow, it might not happen next year, but it will inevitably occur, and we have to have a plan for the worst. This is what we call a purpose-based retirement.
Yeah, and you may not even know right now how much risk is in your portfolio. Well, here's an opportunity to do something about that. You can be one of the next 10 people to jump on the phone and ask for a complimentary review of your entire retirement plan. That will include a risk analysis to tell you just how much at risk are you if the market goes through that big pullback that could be coming. What about taxes? What about expenses? A lot of factors could be nibbling away at your retirement, and exactly at a time when you can least afford it. So it's good to understand exactly what's going on in your portfolio, and this complimentary review is one way to get that done. So be one of the next 10 people to pick up the phone and call and ask for that appointment with Casey or a member of the Howard Bailey team to put yourself on the path toward a purpose-based retirement. And if you'd like to learn more about this type of thing, you can always visit thepurposebasedretirement.com. You can request a copy of one of Casey's books, and there's much more to read there, so I hope you will. We'll see you next week. Take care.